Today, we're going to be talking about how to get started in the stock market. We'll go through some common questions people have, such as how to actually start investing, how much money you should invest, and some investment options available to you. Then we'll touch a bit on what to actually invest in when starting out and the right investment strategies for you. If that sounds like something you're interested in, then stick around for this video. Shares are essentially a piece of a company that you own. To purchase a share, you can go through a robo-advisor, fund manager, or open up a brokerage account through a broker or brokerage firm. A financial advisor or fund manager will ask you about your investing goals and how much risk you're willing to take on. Then build your portfolio to try to achieve those goals. Most people open a brokerage account through their bank or broker because it's the quickest and least expensive way to buy stocks. After you deposit money to your broker, you can tell your broker to buy and sell securities on your behalf. Online stockbrokers are the most popular because it lets you do the trading yourself. That means researching, choosing, buying and selling individual stocks or funds on your own. The amount of money you should invest depends on your risk profile and the time horizon of your investment. You shouldn't invest money that you might need in the short term. It's important to only invest what you can afford to lose. In my personal opinion, I recommend a minimum of $1,000 per stock because of brokerage expenses. Every time you buy and sell a stock, you'll be charged roughly $20 depending on your broker before switching to a percentage for larger trades. So after buying and selling a stock, you'll already be losing $40 in transaction fees, which is 4% of your initial investment of $1,000.
2 + 2 is 4, -1, that's 3, quick maths.
With only $1,000 invested, it's also going to be really hard to diversify. Diversification, by nature, involves spreading your money around. The most basic way to put this is don't put all your eggs in one basket. But the less money you have, the harder it is to spread. So what's the solution to this? It's to invest in mutual funds, index funds, or exchange traded funds, ETFs. A mutual fund is essentially a financial vehicle made up of a pool of money collected from many investors. This is actively managed by a fund manager who then allocates the fund's assets and structures it to match the investment objectives outlined in the prospectus. An index fund and ETF are both very similar in that they are a type of mutual fund which mirror or track a market index or commodity. For example, S&P 500 in the US or ASX 200 in Australia. They are passive investments that inherently provide you a diversified portfolio due to their broad market exposure. But they only go up or down with the market index or asset they're tracking. This means they don't try to outperform the market, they only follow it. So you'll need to look into what index, sector or asset is being replicated by the fund and whether that's the right investment strategy for you. I'd also like to put a disclaimer that although I'm qualified to provide financial advice, the information that I'm providing is purely my own thoughts and opinions. It should not be taken as general or personal advice in the capacity of a financial advisor.
NANI?
I'm just a random person on the internet, so make sure with all the information you're learning here, do your own research or seek professional help from a financial advisor. Now that I've made that clear, when it comes to where to invest, it really comes down to two things. Number one, time horizon. How long will you be investing to achieve your particular financial goals? An investor with a longer time horizon can usually take on more volatile investments because he or she can ride out the waves in the economic cycles. However, an investor with a shorter time horizon doesn't have this opportunity and is therefore more exposed to short-term volatility. We also know that markets tend to go up in the long term because the economy keeps on growing. But in the short term, markets can be irrational, sporadic, and unpredictable. That's why it takes a lot of skill to day trade, and I would avoid this altogether if you're just getting started. I'd say you need at least 100 hours of research before you start investing, but over 1,000 hours of research before you start trading. But ultimately, you and only you are responsible for the financial decisions that you make.
Meanwhile,
Number 2, risk tolerance. How much risk are you willing to take? Are you willing to lose some or all of your investment in exchange for greater potential returns? Do you have the time and desire to learn the skills necessary to become an active investor? If not, then invest in index funds or ETFs instead, because only a tiny percentage of investors are able to select stocks that beat the market. However, if you've done your research and have high conviction towards a specific company's business model and value proposition, you can go down that route as well. You can even split your asset allocation into individual stocks and ETFs, but that will generally require a larger capital investment. If you know nothing about investing, I highly recommend a buy and hold strategy of mutual funds, index funds, or ETFs. They automatically provide diversification and are statistically proven to beat individual stock selection most of the times, especially if you are just a beginner. Is it possible to build a market-beating, diversified portfolio out of individual stocks? Sure, but doing so requires more time, a lot of research, and knowledge on portfolio management and asset allocation. Mutual funds, index funds, and ETFs do that work for you. Just remember, investing is a long-term game. While investing in stocks is relatively simple, the trading portion definitely isn't. Thank you for watching, and I hope you found some value in this video. If you did, please hit that like button and subscribe.